CSL spent 3 decades earning a valuation premium that almost no other ASX stock could match, and the market just repriced that premium to zero in a single session. On May 11th, CSL's interim CEO Gordon Naylor delivered the company's fourth major guidance downgrade in 2 years, and the stock fell 16% to close below AS 101, briefly touching AS 93.63 intraday, a price level not seen since 2015. That alone would be painful, but the reason the market's reaction was so severe goes beyond the earnings cut itself. The standard read is that U.S. immunoglobulin inventory normalization, Chinese albumin price deflation, and Middle East revenue disruption together explain the U.S. $650 million revenue shortfall. Those three headwinds are real, and they do explain the FY26 NPTA landing at US $3.1 billion, rather than the 4 to 7% growth management guided in February. But what capital was actually repricing on May 11th was not a single bad quarter. It was the accumulated evidence that CSL's management cannot forecast its own business across a 6-month horizon. A guidance miss in isolation reprices earnings. 4 guidance misses in 2 years reprice the trust premium that once justified paying above-market multiples for a healthcare compounder. The distinction matters for positioning because those two types of repricing have different recovery timelines and different conditions that would reverse them. An earnings miss recovers when the next result beats. A trust premium recovers only when management demonstrates forecast accuracy across multiple cycles, and with an interim CEO still in place and no permanent replacement announced, that cycle has not begun. The US $5 billion in additional non-cash impairments flagged across FY26 and FY27, on top of US $1.1 billion already taken in the first half, confirms that the book value of the Vifor acquisition, which cost CSL entry into nephrology and iron therapies, has not come close to delivering its projected return on invested capital. What makes the impairment figure structurally significant is where it falls. The Vifor intangibles and underutilized infrastructure, including assets inside the Seqirus Vaccines division, are being written down not because the market changed, but because the original capital allocation thesis was wrong. Interim CEO Naylor acknowledged that US $32 billion in invested capital was not all working as hard as it should, a statement that, embedded in a profit downgrade, shifts the valuation framework from growth compounder to capital efficiency recovery. That shift is what drove fund managers to reweight out of CSL and into smaller healthcare names on the same day, with Cochlear gaining 1.2% and several smaller names rallying more than 4%, not on their own news, but on redirected healthcare allocation. The question that reweighting leaves open is whether the problem is confined to Vifor or whether it extends into the core Behring plasma franchise, where competitor capacity has materially increased. The broker consensus on CSL never moved to sell through the entire decline from AS 308 in mid-2024 to below AS 101 on May 11, and that persistence is what created the capital dislocation visible in this week's sector flows. In the days following the downgrade, the range of broker target price cuts was striking, not for their disagreement, but for their uniformity of direction while maintaining buy or hold ratings. Morgan's cut from AS 241 to AS 147, retained buy. Macquarie moved to AS 111 from AS 176, retained neutral with a 20% earnings uncertainty discount applied explicitly. Bell Potter moved to AS 100 from AS 155. RBC cut to AS 113. The divergence between Morgan's at AS 147 and Bell Potter at AS 100 is not a difference of opinion on CSL's quality. It is a difference of opinion on one specific question, whether Behring's gross margin can recover toward pre-COVID levels near 57%. Bell Potter's note identified further gross margin degradation in Behring as the most concerning data point in the update, not the revenue shortfall and not the Vifor impairment. That framing matters because gross margin degradation in plasma processing is a competitive signal, not an operational one. Competitor capacity expansion has created excess plasma supply in the U.S. immunoglobulin market, and excess supply in a commodity-adjacent product drives pricing down and margins with it. That is a structural condition that does not resolve through cost savings or inventory normalization. Macquarie's explicit 20% uncertainty discount on its own valuation is the most analytically honest signal in the broker pack. It is an admission that the earnings base itself cannot be reliably modeled, which is precisely the condition under which the trust premium evaporates. The countersignal we're holding is that brokering analysts, on average, had already discounted management guidance heading into May 11, factoring in a revenue decline of only 0.5% when management had guided 2.5% growth. That preemptive discount did not prevent the sell-off from being described as more severe than expected, which means the market moved well beyond consensus estimates even on a downside scenario. That gap between consensus positioning and actual market reaction is where the real information sits. The 4 sellers on May 11 were not analysts revising models. They were index-weighted funds managing drawdown risk on a position that had already halved. The CSL separation, confirmed for July 2026, introduces a structural variable that most post-downgrade broker notes have not yet fully integrated into their forward models.
The Securus spin-off, scheduled for July 2026, is the single most consequential near-term catalyst for CSL's capital story, and the market has not yet priced it on its own terms. Securus is the world's second-largest influenza vaccine manufacturer, and it has been performing moderately better than anticipated, even as the rest of CSL deteriorates, a fact buried inside a downgrade note, but with significant standalone valuation implications. The impairment disclosures confirmed that some underutilized manufacturing assets within Securus are being written down, which means the separation will transfer a partially impaired but operationally improving business to a standalone listing. That combination, improving operations against a written-down asset base, creates the conditions for a multiple re-rating at separation, provided Securus can demonstrate independent margin expansion without CSL's corporate overhead and V4-related distraction. The recovery condition for holders of the remaining CSL entity is narrower and harder to satisfy. Behring's gross margin must stabilize above current degraded levels before the core plasma franchise can re-attract growth capital. The threshold to watch is not the immunoglobulin revenue line, which management expects to normalize as channel inventory clears, but the gross margin trajectory inside Behring across the second half of FY26. If gross margin stabilizes, even at levels well below the pre-COVID 57% benchmark, it signals that competitor capacity expansion has reached its supply ceiling and pricing pressure is no longer accelerating. If gross margin continues to erode through FY26, the structural thesis held by Bell Potter becomes the operative framework, and the AS100 target price becomes a ceiling rather than a floor. The US $500 to US $550 million in targeted annual cost savings by FY28 is the management lever that could sustain profitability even under continued margin pressure, but US $32 billion in invested capital generating US $3.1 billion in NPATA means the cost program alone does not restore the compounder multiple. The compounder multiple returns only when a new permanent CEO with a credible track record delivers 2 consecutive quarters of guidance met or exceeded, which, given the May 11 downgrade, cannot happen before late FY27 at the earliest. That timeline is the checkoff anchor this analysis introduced at the start. The 4th downgrade in 2 years set the clock, and the 4th miss to first beat interval is the only benchmark that determines whether the trust premium rebuilds or disappears permanently. The leaning here tilts toward partial recovery through the Securus separation, which removes a known drag and crystallizes value, while the Behring gross margin question keeps the full re-rating contingent rather than imminent. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.